Hi, everyone. Thanks for joining. Yeah, we are 10 days past the deadline of when the capital gains exemption was adjusted. What does this mean? We will cover it all in a pretty short amount of time, actually. Today will not be very long at all, and we'll leave a lot of time for a Q&A. So thanks again for joining. Drop your questions at any point in the chat, and we will get around to all of them. We're very excited. So with that, I'm just going to share my screen. Thumbs up if you can see our presentation and these two very interesting political leaders here in Canada who make a lot of big decisions. So thumbs up if you can see it. Perfect. I'll go to full screen. In fact, maybe instead of full screen, I'll go to view as a slideshow. That's probably better. How's it looking? Right. Perfect. Okay, so the capital gains increase strategies for you. What does this mean? I will preface by saying that there are actually some pretty decent silver linings of all of this. And the biggest silver lining is that you're here on a Friday when it's 30 degrees outside, looking for ways to work on your wealth and your strategy. And that is the number one silver lining. Of course, on top of the good vibe and good attitude, you will see there are some actual tactical advantages of what this has done. And we're, of course, very curious to see how it's going to apply to your unique situation. So thanks for joining. We have an all-star cast of different professionals to hit every single angle of it. So I hope it's going to be the most kind of holistic viewpoint for you to dig deep, raise some flags, and dig deeper after the presentation. And of course, during Q&A, I'm Paul Davidescu. I'm just kind of kicking things off. Here is the change summary, just to sort of hit you with the main points. So June 25th, 2024 is when the existing 50% capital gains tax rate changed to 66.7%, and that's on gains over $250,000 and all gains for a corporation. So if you are under a corp and you have investments, the threshold does not apply. It's always been for kind of all gains. Secondly, it's not that the capital gains are taxed at a 66.7%. It's that 66.7% of the capital gains are taxable and added to your yearly income. That can be illustrated, of course, with our fellow accountant and financial advisor in the room in the subsequent slides. But just keep in mind, it does work kind of the way it's worked with other capital gains. Your personal income is taxed through the tax brackets and not on a flat tax rate. And of course, this is the highest for corporations. So you'll see that, there's sort of like a waterfall of how this tax works, and it's through your tax brackets. So you'll see how that works again shortly through an illustration. And you can subtract the costs necessary for selling the property. Don't forget. So if you had renovations, maintenance expenses, commissions, legal fees, transfer taxes, advertising costs, those are all losses that can go against your capital gains and might either keep you under the $250K threshold, or as a corporation, it'll just lessen the blow. So just some high-level change summary stats there that we will dive a lot more into. First on the agenda is, of course, talking about the capital gains change, and then we have Reza next, who will show you a nice illustration to really walk you through it. Tax mitigation for business owners will be after that. Tax saving alternatives to selling your home. There's a lot of ways you do not have to sell your home and still pull out cash for investment purposes or retirement. And we have real estate opportunities from rushed sellers. So what is this doing towards inventory? We'll have that covered by our expert realtor in the room. Here's the gang. We run a mastermind, and we nerd out about these things every month. And this was the most top of mind topic that all of us got from all of our different customers. Even though we do very different things, it all comes down to finances. So we're really excited to have all the pros in the room go deep with you on the things that they do best. And of course, they'll all be happy to connect afterwards as well, as we can't really cover it all in just one short session. And we call ourselves the Profit Pod. So really, it's a one-stop shop for integrated profit strategies. Today's topic is at the core of it. First up is Reza Jafari, who is going to walk us through, how this all works if you're selling assets. Welcome, Reza.
Hey, thank you for having me. This is great. I want to quickly get to it. So basically, I want to just tell you how it would look like in an example. So if you had a property as a young couple, let's say a young couple have a property worth $300,000 in 2014. They bought this property. They sold in 2024, so 10 years later. Now they're sitting at $650,000. This is not their principal residence. This is their rental property, okay? So their capital gains tax, it says right there, as you can see in the middle of the page, it says, I could just highlight as well with my annotation. Yes, there we go. It's $350,000. That's the capital gains. So just skipping over that, what would happen with the new changes is that there's a $7,000 difference with the new changes that they would pay out of pocket. So after these changes, that the tax on 350 capital gains would come to 91,000. Before these changes, it would be 84,000. So now it's 7,000. So you can see as just a very basic example how it has increased the taxes that we have to pay on rental property or any kind of capital gains. Okay. And so on the other side, this is personal because it has that $250,000 of exemption in terms of if you own things personally, you're exempt for the 250, which that goes into the 50% schedule. I don't want to get to the details. We can talk about your specific situation later on. But in terms of having assets under a corporation, how it works is that there is no exemption. So if you can see here, if you have a corporate, let's say real estate that you own, after these changes, it's 117. Before it was 88. So there's $29,000 of extra taxes that you're paying now because of these changes. Okay, that's on a capital gain of 350. So that's how it sort of changed. And I wanted to show it in an illustration like this, so it just makes material sense. Like you get what's going on. So that's that. Now, if we go to the next slide, I have a strategy for, especially we want to have business owners, and then what business owners can do, basically strategies. And the main thing that business owners can do is to build to sell. And if they're just looking at, okay, well, what's the benefit in this? Because there is a benefit. After these changes, they have added sort of benefits, tax benefits to business owners who are wanting to sell their business. So how I see it is, really, you don't, other than the fact that I've heard from people saying, you know what, I want to get out of this country, I don't want to, all this kind of stuff. If you just, everything stays the same, what you want to do to take advantage of this, like what I would suggest for someone to do, is to build a business and be able to sell it. Now, you could just build a business and sell it and get a profit, and it will save you taxes because of these changes. How does that work? Let's say a business owner started their incorporation in 2019, and they sold it in 2029. That's 10 years after. Okay, so they started off with zero, bootstrapped it, whatever it is, and now it's it's worth $3 million. So when this person goes and sells their corporation before these changes in July, since June 25th, it would have costed him, that business owner, $495, but after it's $395. Now there's a little bit of ifs and whatever, but what happens is they have now pocketed $100,000. So this new rules that has been implemented with the capital gains tax, it has some benefits as well, especially for the business owners who have that ability to be able to build their business and sell. So by the way, if you have any questions, just put it down below. And that's how I see, as an accountant and a business owner, that's how I see it. We can't do much about it as an accountant. There is no way to get around it. It is what it is. And people could have done certain things before June 25th, which is gone. We can't think about it anymore. So that's just about me. I think now it's Alex Walford's time, but I would just like to let you guys know that it's really important to have a group of advisors. And I love doing these sessions because everybody is just so relaxed, because we have advisors and people who know exactly in their specific niche what needs to happen. And financial advisor is a must-have, just like an accountant, just like a mortgage broker, just like an advisor, like a real estate professional. So Alex is our financial advisor, and he's going to go through what you can do financially. That I went through what you could do, what the scenario is. So go ahead, Alex.
Yeah, perfect. Thanks for summarizing the changes, Reza. So, you're perhaps in a position where you have a family vacation or rental property with a large unrealized gain, or you've built up, significant investments within your corporation. As Reza has shown, the new tax legislation increases the amount of tax you have to pay. So that's the bad news. The good news is that there are a couple options available to us. So the first is, I'd say, if you're not already, consider utilizing your available RRSP contribution route. I find there's this misconception among business owners and higher earners that RRSPs aren't really made for them. Yes, they're most valuable when you're in a much lower tax bracket in your retirement years than when you were contributing to the RRSP, but the tax deferral opportunity alone makes them worth considering still in nearly all cases, and especially so now with the increasing tax rate on corporations. Again, TFSAs, if you're not already, consider maximizing them. There's a bit of a tax hit up front if you're pulling funds out of your corporation to put into the TFSA, but I'd call it short-term pain for long-term gain. Bit of a tax hit up front, but then tax-free growth indefinitely thereafter. So that's, I'd say, the lower hanging fruit, but maybe you're already contributing to both of those accounts. What else can you do? And here's two scenarios that I want to walk through where I'd see bigger opportunity. Next slide there, Paul. Thank you. So let's say this is this one might be a bit surprising for people. We're used to thinking about insurance as a way to mitigate or transfer risk, right? I buy home insurance so that if my home burns down, it mitigates the risk of financial loss to me, right? I've transferred that risk to the insurance company. But because insurance is paid out tax-free, it can also be a powerful way to grow tax-free wealth. So let's say your scenario is you have a company with retained profits or surplus cash that it's not being paid out to you. You don't need that money. It's just building up within your corp, and you're using it to invest in GICs or other taxable investments that are ultimately earmarked for your heirs. Ideally, you want a strategy that enhances the value of your estate and reduces the tax bill that's accumulating for your beneficiaries. So what can we do? Well, your corporation, instead of continuing to accumulate capital and invest within the corp, can use all or part of that surplus cash to purchase a whole life policy. And typically that's done by paying premiums, paying into a policy over a 10 to 20 year period. So that policy replaces what would otherwise be taxable investments, all or in part, thereby reducing your current and future tax liability and effectively creating a way to move funds out of your corporation tax-free when you pass. So to be clear, the corporation is the owner and beneficiary of the policy. When you pass, again, insurance proceeds are paid out tax-free, and then it can be dividended out from the corporation to your estate. And that's what the little diagram on the bottom shows. Again, we're talking about, a situation where it's corporate owned. You can own these policies individually as well. If again, you were looking to cover a future tax liability on a legacy, family real estate asset or something, of the like. If we can jump to the next slide, Paul, let's take a look at an example, and see how this can be meaningful. So let's say you had a expected tax liability of about $500,000, maybe within your corp, or again, on this legacy, real estate property. You can purchase a whole life policy, right, with a death benefit of $500,000. In this scenario, I've assumed it's a younger client with close to 50 years left in life expectancy. So to purchase a policy like this would mean paying premiums of about $20,000 per year over the next 20 years. So about $400,000 in total would be put into the policy over the next 20 years. It's a fair chunk. So that's one option. Let's say the alternative, though, is investing that same $20,000 per year in a balanced investment portfolio, which we usually think of as about 60% stocks, more growth-oriented investments, 40% fixed income, slow and steady interest paying, GICs and the like. So those are our two options that we're weighing. And that's what that bottom table shows. let's say that that balanced portfolio has an assumed rate of return of about 6%. And you could see the type of income being earned on it, interest versus dividends versus capital gains. So how do these two options compare? Next slide, Paul. So there's two lines. The green line is the whole life policy. The blue line is that same balanced portfolio. So what you can see is, right, all the way through over the next almost 50 years, that life insurance policy continues to grow in value, right? And its expected value is always higher than just investing the same funds in a taxable investment account. Why is that? Well, for one, the death benefit, right? Day one, if you purchased this policy and passed away the next day, there'd be a $500,000 tax-free payout, right? That's ultimate. That's a big part of what you're purchasing. In addition, though, the policy continues to grow in value, right? As the life insurance company pays out dividends, such that, you know, at the end of your expected life, and that's what shows on the bottom, the life insurance policy is expected to be worth about $3.6 million versus, again, investing that money in a taxable account, worth somewhere in the neighborhood of $2.375 million. So over a $1.2 million difference. And this, again, highlights the main benefit of insurance, which is that it's paid out tax-free. And that's what can make it such a powerful wealth creation asset. Now, to be clear, this option is about maximizing the value of your estate and reducing the tax obligation for your heirs. But what if my main priority is, frankly, maximizing the value now and being able to utilize it, enjoy it in my retirement years? And that's the next option I want to go over with you. So the second option available to you is what's called an individual pension plan. So we talked about RRSPs earlier. What if you had the opportunity to supercharge your RRSP? So we all hear about these kind of cushy government pension plans available to government workers or, you know, Trudeau and the like. That type of plan is called a defined benefit plan. So the good news to business owners is that you have the option to effectively create your own defined benefit plan. And that's referred to as an individual pension plan. So who's it useful to? As the first bullet shows, business earners and incorporated professionals over the age of 40 with at least $100,000 in earned income or T4 earnings. So why is it useful? Well, it allows you to make substantially higher contributions than you'd otherwise be able to make to your RSP. So in 2024, the maximum RSP contribution you can make is 18% of your earned income. That's always been the case. But there's a ceiling, a cap put on that of $31,560. When you make $175,000 per year, you've reached that limit, that cap. So the IPP allows you to continue contributing even if you earn more than that $175,000 limit. An added benefit is that IPPs allow for a substantial one-time tax-deferred contribution out of your corporation when the plan is first established, right? And to be clear, again, these contributions are coming from your corporation. They are your employer of the pension plan, effectively. And those contributions then, of course, are tax deductible to your corporation, and they're non-taxable to you as the employee. So let's, again, look at an illustration to get a better idea of how these work and why there's benefit. You can jump to that and click again there, Paul. Perfect. So let's look at a case study. Let's say you're a professional, you're 55 or thereabouts, you've been incorporated for about 10 years. You're currently in that maximum T4 bracket, so you're earning more than $175,000 per year. You've hit that ceiling. And you currently have about $300,000 in RRSPs. What you can do in setting up an IPP is immediately fund it to the tune of $173,000 to fund past service, right? Or to fund basically that last 10 years that you've been an employee of your corporation. Again, tax deductible to the company. No tax implication of withdrawing that capital from your corp. Over the rest of your working years, 10, 15 years, up till age 71, you could contribute up to $660,000 more, right, in tax-deductible contributions over that time. Again, what makes the IPP so beneficial, right, is that annual contribution is considerably higher than you could do to your RRSP. So that's what the table on the left shows. Again, in this example, the individual's age 55. They're limited in the RRSP, again, to $31,560, but they could make a contribution to their IPP of over $45,000. So over $13,500 higher, 43% higher. And that just continues to grow as you get older, right? By age 65, you could contribute $52,000 to your IPP. That's over $20,000 more than you could to the RRSP. So end result is in the IPP, you're able to accumulate far more for retirement. In this example, up to $1.4 million more, assuming they have the same rate of return in assets in the IPP versus the RRSP. So these are just two strategies that, the end goal is ultimately to pull more capital out of your corporation, right? The government's made it clear, corporations are enemy number one. That's where we're going after. That's who we're going after for more tax dollars. So both of these strategies aim to allow you to pull money out of your corporation on a tax-free or tax-deferred basis, ultimately reducing your future tax liability. So if either of these are of interest, feel free to email me after. Happy to chat about them further and see if they apply to your situation. Yeah. Thanks, Paul.
Thank you, Alex. We're at the end. Thank you for everyone who enjoyed and stayed and was active and turned on their cameras. Very grateful. We'll open it up for a few minutes for any questions from either Blake or Donna. Feel free to type it in or unmute yourselves, and then we'll roll into the weekend. We're so grateful you guys could join. I know it's such a tempting sunny day today, so this is awesome. I love it.